In January 2025, Donald Trump returned as President of the United States. His comeback immediately reshaped the tone of global politics. The trade war with China, which began in 2018, has now escalated into a broader and deeper confrontation that touches nearly every sector of the global economy. What started as a dispute over tariffs has transformed into something far bigger. A strategic competition involving critical minerals, advanced technologies, pharmaceuticals, shipbuilding, energy security, and even the global financial system itself. Over the next half hour, we'll explore in depth why this conflict began, how it has evolved, and what it means for the future of the world economy. We'll look at China's dominance in rare earths and shipbuilding, the United States' attempts to rebuild its critical industries, the financial tug-of-war over Treasuries, and the stark reality that sanctions against China would not work, the way they did against Russia. This is not just a story about trade. It's about the fundamental restructuring of globalization, the rise of new blocs, and the weapons of economic warfare in the 21st century. The question is not whether the U.S. and China are in conflict. They are. The question is, how far will it go, and who will pay the highest price? To understand today's escalation, we need to go back 2 decades. In 2001, China joined the World Trade Organization. For the United States and Europe, this was the ultimate bet on globalization. Bring China into the global system, and everyone would benefit. And for a while, it seemed to work. Western consumers enjoyed cheap electronics, clothing, and furniture, while corporations profited from outsourcing. But the downsides soon became clear. American factories closed, jobs were lost, and accusations grew that China was subsidizing exports, forcing technology transfers, and failing to respect intellectual property rights. By the mid-2010s, the political mood in Washington had shifted. China was no longer seen as just a partner, but as a competitor, even a threat. The turning point came in 2018. Trump's administration launched a Section 301 investigation and imposed tariffs on hundreds of billions of dollars of Chinese imports. Beijing retaliated. In 2019, the U.S. began targeting Chinese companies like Huawei, restricting their access to American technologies. The dispute had moved beyond tariffs and into systemic rivalry. In January 2020, the so-called Phase 1 deal was signed. Beijing pledged to increase purchases of American goods and strengthen IP protections. But then the COVID-19 pandemic hit. Supply chains snapped, and the world saw just how dependent it was on Chinese factories and ports. The Phase 1 commitments were quickly overshadowed by distrust. By 2022, the Biden administration tightened export controls on advanced chips and semiconductor equipment. The rhetoric softened, but the substance remained the same. Tariffs, tech bans, and restrictions stayed in place. And then came 2025. Trump returned, immediately raising tariffs to 60% on electronics and cars, and even floated 200% tariffs on rare earth magnets. It was clear this conflict was no longer temporary. It was becoming the defining feature of global trade in the 21st century. Why is Washington so determined to confront Beijing? There are 4 key reasons. First, the trade deficit. The U.S. imports roughly 3 times as much from China as it exports. This imbalance has become symbolic of America's economic decline in the eyes of many voters, and Trump built his political brand on promising to fix it. Second, the technology race. The future of power lies in semiconductors, artificial intelligence, 5G networks, and military applications. The U.S. fears that China could leapfrog it in these critical sectors, undermining America's long-standing technological edge. Third, geopolitics. The Asia-Pacific region is now the central arena of global power competition. China seeks to dominate its neighborhood and project influence through initiatives like the Belt and Road. The U.S., meanwhile, wants to maintain its role as the primary security guarantor. And fourth, domestic politics. Trump's slogan, "Make America Great Again," rests heavily on the promise of bringing back manufacturing jobs. Tariffs and trade wars are not just economic tools. They're political weapons to show voters that he is fighting for them. Put simply, America sees China as both the greatest economic competitor and the greatest strategic threat. That combination ensures the pressure will not ease anytime soon. Trump wasted no time in his second term. By February 2025, his administration had announced sweeping tariffs, up to 60% on Chinese electronics, steel, and automobiles. Even more dramatic was the threat of a 200% tariff on rare earth magnets, an essential component for everything from smartphones to fighter jets. These measures rattled markets. Tech stocks fell, metals prices surged, and supply chain managers scrambled to find alternatives. But the message from Washington was unmistakable. The U.S. intends to reduce its reliance on China at almost any cost. Critics argue that tariffs raise prices for American consumers and hurt small businesses that depend on Chinese components. Supporters counter that short-term pain is worth long-term independence. Trump himself framed it as a matter of survival. China has been stealing from us for decades. That era is over. In practice, the policy is about more than tariffs. It's about reshaping global production networks, pulling supply chains out of China and into places like Vietnam, India, Mexico, and back into the U.S. itself. It's also about industrial policy, pouring billions into subsidies for domestic chip production, mining projects, and shipbuilding. This is the heart of Trump's economic nationalism. Use tariffs as a weapon, punish competitors, and rebuild. American industries threw both sticks and carrots. Beijing has not stood idle. China responded with tariffs of its own, targeting U.S. agriculture, soybeans, corn, and pork, the lifeblood of Trump's rural political base. Farmers across the Midwest now face shrinking export markets, forcing Washington to consider new subsidies. At the same time, China tightened its grip on strategic exports. Restrictions were imposed on graphite, gallium, and germanium, minerals essential for semiconductors and EV batteries. By flexing control over these choke points, Beijing signaled it can inflict pain too. Perhaps most significantly, China is promoting the yuan as an international trade currency. More than 20 BRICS and Global South nations now settle part of their trade in yuan, eroding the dollar's monopoly. This is still a small share globally, just about 3% of reserves compared to 60% for the dollar. But the trend is clear. In short, China is countering on multiple fronts: economic, technological, and financial. This is no longer a tariff dispute. It's a contest over who sets the rules of the global economy. One of China's most powerful levers is its control over critical minerals. Beijing dominates rare earth refining, with about 90% of global capacity and over 60% of mining. Without rare earths, there are no advanced weapons, no smartphones, no EV motors, but rare earths are only part of the story. Graphite. China produces 99% of battery-grade graphite, essential for lithium-ion anodes. Cobalt. More than 85% of global refining is in China. The mining is done mostly in Congo, but China processes it. Lithium. China controls 65% of refining, turning raw material into usable battery chemicals. Gallium. Over 90% is refined in China. Germanium. More than 80%. Antimony, bismuth, arsenic. China holds between 50% and 80% of supply, and then there's pharmaceuticals. 80–90% of the active pharmaceutical ingredients, APIs, for U.S. generics come from China. That includes antibiotics, vitamins, and cancer treatments. In other words, China is not just the world's factory for cheap goods. It is the world's refinery for critical inputs. Losing access to them would cripple multiple industries simultaneously, from defense to clean energy to healthcare. When we think of economic power, we often focus on chips or minerals. But there is another sector where China quietly dominates: shipbuilding. Ships are the arteries of global trade. Without them, goods don't move. China today builds more than 50% of all ships worldwide. By tonnage, its largest shipbuilding conglomerate produces more than the entire American industry combined. In contrast, the United States builds fewer than 5 commercial ships a year. Yes, fewer than 5. This is a staggering imbalance. Even militarily, the numbers are sobering. China's Navy now fields 234 combat vessels compared to America's 219. The gap is not just in quantity, but also in speed. Chinese shipyards can launch new ships at a pace the U.S. has not seen since World War II. Why does this matter? Because shipbuilding is not just about economics. It is about national security. If conflict were to break out in the Pacific, America would depend on its shipyards to replace losses and sustain logistics. Right now, those shipyards are woefully underpowered. Washington knows this. That's why Trump has welcomed a $150 billion investment from South Korea to expand U.S. shipyards like Philly Shipyard, aiming to produce 20 ships a year. It's a start, but still a fraction of China's scale. The shipbuilding gap illustrates the broader theme of this conflict. China has become not only the workshop of the world, but also the shipyard of the world. For the U.S., catching up will require a wartime-level mobilization. It would be easy to think this is a one-way story of Chinese dominance, but the truth is more complex. The U.S. and China are locked in a web of mutual dependence. On the one hand, the U.S. relies heavily on China for minerals, pharmaceuticals, and consumer goods. On the other hand, China has its own critical vulnerabilities. First, semiconductors. China cannot mass-produce cutting-edge chips below 7 nanometers. It relies on U.S. companies like NVIDIA, on Taiwan's TSMC, and on Dutch company ASML for EUV, lithography machines. Without these, China's AI ambitions hit a ceiling. Second, markets. Roughly 16 to 18% of all Chinese exports go to the U.S., worth more than $400 billion a year. That's a massive share of demand that Beijing cannot easily replace with Europe or the global South. Third, finance. The global system still runs on the dollar. Around 60% of global reserves are held in dollars, while the yuan accounts for just 3%. China holds about $800 billion in U.S. Treasuries, but it cannot fully exit the dollar system without destabilizing its own reserves. Fourth, agriculture. China imports enormous volumes of American soybeans, essential for feeding its 440 million pigs. No other supplier can replace that volume quickly, so the dependency cuts both ways. Washington fears China's mineral chokehold. Beijing fears America's control over technology, finance, and its access to the U.S. market. This dual vulnerability is why the conflict is so dangerous, and why a clean break is almost impossible. Some ask, why not sanction China the way the West sanctioned Russia? The difference comes down to scale and substitutability. Russia is primarily an energy exporter. When Europe cut Russian pipeline gas after 2022, it scrambled, but managed to replace most of it with LNG from the U.S., Norway, and Qatar. Russian oil was capped with a price ceiling. Sanctions on shipping and insurance raised costs, but did not collapse global trade. Painful, yes, but manageable. China is different. It is not just an exporter of one resource. It is the industrial heart of the world. Rare earths, lithium batteries, solar panels, pharmaceuticals, ships. All of these are dominated by China. Try to cut that off, and you don't just hit Beijing. You paralyze the global economy. Even targeted sanctions would create cascading effects. Restrict gallium or germanium. Chip production everywhere suffers. Restrict graphite. EV supply chains grind to a halt. Restrict APIs. The U.S. pharmaceutical industry faces shortages. In short, sanctions against China cannot be copy-pasted from the Russia playbook. The scale of integration is simply too deep. The only theoretical way to constrain China by force would be maritime. Up to 80% of China's oil imports travel through the Malacca Strait. A blockade there could strangle resources. But such a move would be nothing short of an act of war, a direct superpower clash with unpredictable consequences. So while sanctions crippled Russia's revenues, doing the same to China would cripple the entire world economy. That is why Washington must tread carefully. There is another battlefield, the bond market. For decades, China was one of the largest holders of U.S. Treasuries. This was the financial symbiosis. America ran deficits, and China recycled its surpluses into safe U.S. debt. But since 2013, Beijing has been slowly unwinding its position. Back then, it held more than $1.3 trillion in treasuries. Today, it holds less than $800 billion, the lowest level in nearly 15 years. This is no accident. It is a deliberate, gradual sell-off. China doesn't want to crash the market, but it wants to reduce its exposure to American debt. The signal is clear. Beijing no longer wants to bankroll Washington's deficits. If China were to accelerate sales, the consequences would be severe. Treasury yields would rise. Borrowing costs for the U.S. would jump. Mortgages would get more expensive, and servicing America's $35 trillion debt would become harder. At the same time, Japan and other investors have picked up the slack. Total foreign holdings of treasuries are still growing, masking China's retreat. But the trend matters. It shows that treasuries themselves, the bedrock of the global financial system, can be weaponized. This is economic warfare at the highest level. Tariffs hit trade, sanctions hit companies. But messing with treasuries? That strikes at the core of America's financial stability. China's dominance does not stop at rare earths and ships. Consider the clean energy transition. China controls more than 80% of the global solar supply chain, from polysilicon to wafers to modules. It controls about 75% of global lithium-ion battery production. In other words, the green transition in the U.S. and Europe is, for now, a Chinese supply chain. In pharmaceuticals, as mentioned earlier, the dependence is just as stark. Roughly 80–90% of active pharmaceutical ingredients for U.S. generics come directly or indirectly from China. Antibiotics, vitamins, even critical oncology drugs, America imports them. Add to this gallium, germanium, antimony, and other small metals that no one notices until they disappear. Suddenly, China looks less like one player in the system and more like the system itself. The U.S. is trying to respond. Trump has pushed billions of dollars into mining projects, subsidies for domestic refineries, and partnerships with allies like Australia, Canada, and Brazil. But building alternative supply chains takes years, even decades. So while Washington talks about resilience, in reality, it will remain dependent on Chinese-controlled materials for the foreseeable future. This is the paradox of the conflict. America wants to decouple, but decoupling is a marathon, not a sprint. All of this leads to a bigger picture, the slow death of the old model of globalization. For 30 years, the world operated on a simple formula: design in the West, manufacture in China, and sell everywhere. That model is now unraveling. Companies are adopting a China plus one strategy, moving some production to Vietnam, India, and Mexico. Supply chains are fragmenting. Governments are pursuing industrial policy, subsidizing domestic production, even if it costs more. But this is not true decoupling. Instead, we are entering an era of bloc-based globalization, one bloc led by the U.S., Europe, Japan, and allies. Another led by China, Russia, and the BRICS. Each bloc will try to secure supply chains within its sphere and reduce exposure to the other. This has huge implications. Prices will be higher, efficiency lower, but resilience will increase, at least in theory. For consumers, it means inflation may become structural. For businesses, it means rethinking everything from sourcing to logistics. The trade war is not just about tariffs. It is about the architecture of the 21st century economy. The question is no longer, how do we globalize, but how do we re-globalize in blocks? We are witnessing a historic shift. The U.S.-China trade war, once seen as a temporary spat, has become the defining struggle of our time. The weapons are not tanks and missiles, but minerals, chips, ships, and bonds. The battleground is not just the South China Sea, but also the semiconductor fabs of Taiwan, the shipyards of Shanghai, and the Treasury auctions in New York. Who will prevail? The U.S. trying to rebuild its critical industries and defend its financial system? Or China, which already controls half of the world's industrial capacity and is positioning itself as the backbone of the global South? The answer will unfold in the coming years. But one truth is already clear. The world of the past, a single integrated globalization, is gone. The future is fragmented, contested, and uncertain. We are entering an era where economic warfare is constant, and where resilience is the new currency of power. The U.S. and China are no longer just trading partners. They are rivals, shaping the fate of the global order, and for all of us, the stakes could not be higher.